Result: for over 70 years, the US dollar has maintained its pivotal role at the heart of the global financial landscape. As the world's reserve currency, it serves as the primary medium for international trade and the asset that nations turn to in times of economic uncertainty. Throughout history, the dollar has withstood wars, recessions, oil crises, and market crashes, emerging resilient through each tumultuous period. However, the quiet maneuvers taking place within China warrant significant attention. Without the fanfare of dramatic announcements or urgent news alerts, China has been methodically reducing its reliance on the US dollar. Over time, approximately $3 trillion in dollar-linked assets have been restructured, diversified, or redirected towards alternative investments. This process is not one of panic. Rather, it reflects a deliberate, strategic long-term decision. This calculated approach poses a considerable threat to the established financial order. Financial dominance does not dissipate in an instant. Instead, it erodes gradually through subtle shifts in reserves, changes in trade settlements, and calculated exits from dollar dependency. By the time the broader public becomes aware of these developments, the repercussions may already be profound. China recognizes a crucial principle of global influence. Financial resources serve as leverage. For decades, the United States has wielded the dollar as a means of control, dictating global trade dynamics, imposing sanctions, freezing assets, and determining access to the financial system. Beijing has observed these patterns closely. Each sanction, every frozen reserve, and all nations excluded from dollar markets convey a powerful lesson to China. Reliance on the dollar presents a significant risk. In an era marked by rising geopolitical tensions, it is imperative to mitigate such risks. This is not an immediate quest to dismantle the dollar's supremacy. Instead, it is a preparation for a future where the dollar may no longer function as a tool of economic warfare. The transition is already in motion, though many remain unaware of its implications. When the global community finally recognizes these shifts, the landscape of international finance may very well be transformed irrevocably. To understand why China's move is so significant, you first need to understand how the US dollar became nearly impossible to challenge. After World War II, much of the world's economy was in ruins. Europe was devastated, Asia was rebuilding, and global trade was frozen. The United States, however, emerged not just intact but stronger than ever. It controlled the majority of the world's gold reserves, dominated industrial production, and held unmatched political influence. This power was formalized through the Bretton Woods system. The dollar was pegged to gold, and other major currencies were pegged to the dollar. In simple terms, the dollar became the bridge between money and trust. If you held dollars, you held stability. Even after the gold standard collapsed in the 1970s, the dollar didn't fall. Instead, it evolved. The US struck deals that ensured oil, the lifeblood of the global economy, would be priced in dollars. This created the petrodollar system, forcing every country to hold dollars just to function. Over time, global trade, debt, banking, and reserves became deeply dollar-dependent. International payments ran through dollar-based systems. Global loans were issued in dollars. Central banks stockpiled U.S. Treasury bonds as their ultimate safety net. This gave the United States an advantage no empire in history had ever possessed. America could print money, and the world would absorb it. It could run massive deficits and still attract buyers. Most importantly, it could enforce financial sanctions with devastating precision, cutting countries off from the global system without firing a single shot. For decades, there was no alternative. Challenging the dollar meant challenging the entire financial architecture of the world. Until now, because once dependency turns into vulnerability, power begins to shift. China did not wake up one day and decide to abandon the dollar. What we are seeing today is the result of a plan that has been developing quietly for more than a decade. For years, China was one of the largest holders of U.S. Treasury bonds. These assets were safe, liquid, and dollar-denominated, perfect for a country that depended heavily on exports to the West. But safety came with a hidden cost: exposure. Every dollar China held was ultimately controlled by a system run from Washington. The turning point came when the United States began weaponizing finance. Sanctions, asset freezes, and restrictions on international payments sent a clear signal. Reserves were no longer politically neutral. They could be frozen, seized, or rendered useless overnight. China took notes. Instead of dumping U.S. assets suddenly, which would damage its own economy, China began a slow, controlled exit. Treasury holdings were reduced. Reserves were diversified. Capital was redirected into gold, strategic commodities, infrastructure, and non-dollar trade arrangements. At the same time, China pushed the internationalization of the yuan. Trade agreements increasingly settled in local currencies. Currency swap lines were expanded. Energy deals with Russia, the Middle East, and Asia were structured without the dollar at the center. This is where the $3 trillion figure becomes critical. It doesn't represent one transaction. It represents a decade-long repositioning, a shift away from dollar dominance and toward financial self-defense. Every percentage moved out of the dollar reduced China's vulnerability to sanctions and financial pressure. The goal was never to crash the dollar. The goal was to make China sanction-proof. And in doing so, China has exposed a truth the world can no longer ignore. The dollar's power only exists as long as others agree to depend on it. China's move alone is not enough to end dollar dominance, but it doesn't need to be. The real danger for the dollar isn't a sudden collapse, it's momentum. Once major players begin to diversify, others start asking the same question: why are we still so exposed? Across the world, countries have been quietly following similar paths. Central banks are buying record amounts of gold. Bilateral trade deals are being settled in local currencies. Alternative payment systems are being developed outside U.S. control. Each step may seem small. Together, they signal something much bigger. The U.S. dollar's strength depends on constant global demand. The moment that demand slows, even slightly, the system starts to strain. Higher interest rates become necessary to attract buyers. Debt becomes more expensive. Printing money becomes riskier. This is where the cracks begin to show. America carries unprecedented levels of debt, funded by the assumption that the world will always buy U.S. treasuries. But if large holders gradually reduce their exposure, the burden shifts inward. Domestic inflation rises. Financial volatility increases. Policy options shrink. Meanwhile, the tools that once guaranteed dollar dominance, sanctions, and financial pressure are losing effectiveness. Every time they are used, they push more countries to seek alternatives. China understands this dynamic perfectly. It doesn't need to replace the dollar. It only needs to weaken the belief that the dollar is unavoidable. Once that belief breaks, the system begins to fragment. And fragmented systems don't favor empires, they favor those who prepared early. China's $3 trillion shift is not the end of the dollar, but it may mark the beginning of a different world order. The global financial system is moving from a single center of power towards something far more complex. Instead of one dominant currency, we are entering an era of competing monetary blocks: the dollar, the yuan, gold-backed trade, and regional settlement systems all existing side by side. In this world, influence is no longer absolute. It is negotiated. For the United States, this means hard choices ahead. Maintaining dollar dominance will require higher interest rates, fiscal discipline, and restraint in using financial power as a weapon. The era of unlimited leverage may be coming to an end. For China, the strategy is clear. Reduce vulnerability, increase independence, build systems that function even when cut off from the West. This is not economic warfare. It is preparation. For the rest of the world, the message is unmistakable. Dependence has a price, and diversification is no longer optional. History shows us that reserve currencies don't disappear suddenly. They fade as alternatives become credible. The British pound didn't collapse overnight. it slowly lost relevance. The same process may now be beginning with the dollar, not with a crash, not with chaos, but with a quiet shift measured in trillions that changes everything.